we learned the basics of Goodwill valuation. What is the meaning of Goodwill? What are the factors influencing the valuation of Goodwill, and different methods of valuation of Goodwill. So these things we have seen theoretically in the previous lecture. Now we will be focusing on some of the model sums by applying all the methods in the valuation of Goodwill. So let me give you a small sum which is most predominant for a multiple choice question. Company X acquires all the assets of Company Y, giving Company Y rupees 15 lakhs cash. Company Y has a cash of rupees 50,000 accounts receivable that are believed to be realized at rupees 60,000, and other identifiable assets that are estimated to have a current market value of rupees 11 lakhs. Keep that in mind. And now how to calculate the goodwill. So here you can understand what is goodwill, how it used to be calculated, basically from the acquisition. So when the total purchase price is said to be as rupees 15 lakhs, and subtract the cash acquired, that is 50,000, amounts receivable, that is the realizable amount 60,000, and other identifiable assets, that means tangible assets, estimated at rupees 11 lakhs, which means net realizable value of assets altogether, it comes around 12,10,000, but the purchase price is 15 lakhs. So what happens in the difference? So here the difference is we are paying more than what we are about to receive. We are receiving some assets, but we are paying more. So that excess amount, why do we need to pay? Because the company Y, which we are acquiring, may have a good reputation in the existing field, which will continue for some years in future. So in that case, this differences is called as goodwill, which means we are paying more. The excess whatever we pay more is here we call the term goodwill, because we are paying more due to the reputation of the company Y. So this extra amount of rupees 2,90,000 paid over and above to the net worth of rupees 12,10,000 is called as goodwill, which is a capital loss for purchasing a company. The capital loss is called as goodwill, and it should be shown on the asset side of balance sheet. So any loss, accumulated loss, needs to be shown on asset side, is it not? So the capital loss, which we call as goodwill, have to be shown as in the asset side of balance sheet. This entire amount will be written off against the revenue profit over a period of time. That's why while preparing final account, we used to get an adjustment called goodwill written off 5% like that. So the goodwill used to be written off and adjusted against the revenue profit, which is going to be over a period of time. So with this a short illustration, we came to know what is goodwill, how it is treated, why it is called as capital loss, and how it can be written off in future. So with these four important terms, there used to be MCQ questions, multiple choice questions. Since you have more predominant to attend multiple choice questions, please pay attention. Swayam will release you multiple choice questions every week. So when you attend the Goodwill related questions, definitely it used to be there. The excess amount whichever you paid than what you receive is called as Goodwill during acquisition of a company or a business. Why it is paid extra? Are we mad or the company X is mad to pay extra? No. And the company Y exists into the business field for 10 years and they have built their reputation. For that purpose, they pay more. So that excess amount we call as the Goodwill. That excess amount used to be treated as an asset and a balance sheet, since it is a form of capital loss for purchasing a company or for purchasing a business. Hence, it used to be sold on asset side of this balance sheet. Since it is a capital loss and it used to be written off every year over the period of time against the revenue profit which we generate. So this makes us to understand what is goodwill, what is capital loss, and how it is treated in balance sheet and how it's going to be treated in future. So let me post a few questions now. Try to answer in the comment box. So how are you going to think about this? Okay sir, there is a doubt now. If I pay more, then it is called goodwill. But sometimes if I pay less, what happens? For example, the total purchase price is 10 lakhs, whereas the total assets it comes around 10,000, which is the less than the purchase price. The purchase price is less than the asset value. So now it comes in negative. So can we call the goodwill as a negative amount? No. Which means this we call as capital reserve. This we call as capital reserve. The deficit amount whichever we pay over the assets, then it is called capital reserve, which is a capital profit for a purchasing company, and it to be sold on liability side of the balance sheet. So with this remarkable note, let me proceed to the next sum. Before that, let me post 3 questions for your brainstorming, and think about that and answer in the comment box while watching the lecture along with me, while flowing out the lecture along with me. Question number 1. The goodwill is an intangible asset and treated as dash. The goodwill is an intangible asset. I'm not going to ask what is goodwill. Goodwill is an intangible asset and treated as dash in the balance sheet. Option 1, capital profit. Option 2, revenue profit. Option 3, capital loss. Option 4, revenue loss. That is important. So now is your answer. Try to come out with your answer. Now question number 2. Question number 2. The entire amount of the goodwill will be written off within a year. Validate the statement. Is that true or false? Tell me. The entire amount of goodwill, since it is a loss for purchasing company, will be written off within a year. Yes or no? Validate the statement. Question number 3. The capital reserve used to be shown in the dash on the balance sheet. Liabilities, assets, current liabilities, current assets. Tell me now. Tell me in the balance sheet where it has to be shown. Post in the comment. I will be checking all your responses before the webinar series. We used to have webinar, no? Once in a fortnight, and where I used to post the webinar timing and link in the Swayam, and you are expected to attend. Now let me take you to the next problem. Receipt Computers Limited gives you the following summarized balance sheet as on 31st December. So they have given you the list of assets and liabilities. The assets are fixed assets. The cost of fixed assets 50 lakhs, the accumulated depreciation 30 lakhs, and the net fixed assets value is 20 lakhs. Capital work in progress 40 lakhs. Investment, that is 10%, 5 lakhs. Current assets 25 lakhs. Underwriting commission, rupees 2 lakhs. So total of the assets comes around 92 lakhs. If you take the liabilities, the preferred share capital, rupees 5 lakhs. Equity share capital, rupees 20 lakhs. Reserves and surplus, rupees 25 lakhs. Long-term loans, rupees 27 lakhs. Current liabilities and provisions, rupees 15 lakhs. So altogether it comes around 92 lakhs. Now the company earned a profit of rupees 18 lakhs before tax in that particular year. The capital work in progress represents the additional plan equal to the capacity of the present plan. If immediately operational, there being no difficulty in sales. With effect from 1st January, the upcoming year, 2 additional works manager are assumed the present replacement cost of fixed assets, that is rupees 1 crore, and the annual rate of depreciation is expected to be 10% on original cost. So with this brief explanation of this question, let me proceed and how to calculate the goodwill under different methods. How to calculate the goodwill under different methods. So question is saying, whereas I will be facilitating and learn together how to calculate the goodwill under different methods. So first method, we all know, we have discussed this in the previous lecture. The first method, normal profit. Calculate the normal profit. Suppose investors are satisfied with their 18% return. In the above example, the normal profit will be 18% of 63 lakhs. You know how the 63 lakhs has come? From the net capital employed, 63 lakhs. Of that, 18%, it comes around 11,34,000. Now we need to know what are the items which generally require adjustments in arriving at the average of the past earnings. Which are the general items need to be recorded adjusted. Number 1, exclusion of material, non-recurring items. such as loss of exceptional natural disasters like strikes, fires, floods, theft, etc., which is not going to be regular, exceptional things. So this have to be adjusted. Profit or loss of any isolated transaction not being part of the business of the company. So hence it has to be adjusted. Even if it has occurred in one particular year, this have to be adjusted. Point number 2, the item number 2, exclusion of income and profits and losses from non-trading assets. If you have any non-trading assets, and if you get any income or gains or loss, then that have to be excluded. Excluded in the sense, if already included, then exclude. If it is income or profit, then subtract, because it has already added. Losses, this already subtracted, then added. So that's the general logic we need to apply. Then exclusion of any capital profit or capital loss or capital receipt or capital expenses included in the profit and loss account. Next, adjustments for any matters suggested by notes which are appended to the accounts or by qualifications in the auditor's report. It would be like provision for taxation, provision for gratuities, bad debts, under provision of depreciation or over provision of depreciation, inconsistencies in valuation of stock. So all these are some of the examples. So we need to adjust for any matter suggested by notes which are appended to the accounts by the qualification in the auditor's report. So that have to be counted into the consideration while valuing the profit for calculating the goodwill. Then another important area is depreciation. Depreciation is an important item that calls for careful review. The valuer may adopt book depreciation provided he or she is satisfied that the value was realistic and the method was suitable for the nature of the company, and they are consistently applied from year to year. But imbalances do arise in cases where consistently written down value method was in use and heavy expenditure in the recent past has been made in the rehabilitating or expanding the fixed assets. Since the depreciation charges would be unfairly heavy and would prejudice the seller. So under such circumstances, it would be desirable to read just depreciation suitable as to bring in more equitable charges in the profits meant for averaging. So these 5 things need to be considered when calculating the profit or determining the working capital. Another important factor comes up for consideration in averaging the past profits, and that is the trend of profits unit. It is imperative that estimation of maintainable profits be based on the only available record, that is, the record of past earnings. But indiscriminate use of past results may lead to an entirely fallacious and unrealistic result. So during that case, we need to focus on that and to calculate the profit for determining the working capital. Where the profits of a company are widely fluctuating from year to year, and average fails to aid future projection. In such cases, a study of the whole history of the company and of earnings of a fairly long period may be necessary. So, if the profits of the company do not show a regular trend upward or downward, or vice versa, an average of the cycle can usually be employed for projection of future earnings. So some people will apply average profit, some people will apply weighted average profit, so it differs. In some companies, profit may record a distinct rising or falling trend from year. So in these circumstances, the simple average falls to consider a significant factor, namely the trends in earnings. The shares of a company which record a clear upward trend of past profits would certainly be more valuable than those of a company whose trend of past earnings indicates a downtrend. In some companies, profit may record a distinct rising or falling trend from year. In these circumstances, a simple average falls to consider a significant factor, that is trends in earnings. The shares of a company which record a clear upward trend of past profits would certainly be more valuable than those of a company whose trend of past earnings indicates a downtrend. In such cases, a weighted average giving more weight to the recent years than to the past is appropriate. Hence, a simple way of weighing is to multiply the profits by the respective number of the years arranged chronologically so that the largest weight is associated with the most recent past year and the least for the remotest. So how do we make the future profitability projections for determining the goodwill? So project is more a matter of intelligent guesswork since it is essentially an estimation of what will happen in the risky and uncertain future. The average profit earned by a company in the past could be normally taken as the average profit that would be maintainable by it in the future. If the future is considered basically as a continuation of the past, if the future performance is viewed as departing significantly from the past, then appropriate adjustments will be called for before accepting the past average profit as the future maintainable profit of the company. So there are three methods of calculating goodwill and super profit. Let us discuss those with respect to this particular question. First one, the purchase of super profit method. In goodwill, as per this method, is super profit multiplied by a certain number of years. Under this method, an important point to note is that the number of years of purchase as goodwill will differ from industry to industry and from firm to firm. Theoretically, the number of years is to be determined with reference to the probability of your new business catching up with an old business. Suppose it is estimated that in 2 years of time, your business, if started now, will be earning about the same profits as an old business in your name now. So goodwill will be equivalent to the 2 times of the super profit. So in the example given in the sum, goodwill will be 12,000, which means if the normal profit becomes, that is the super profit becomes 6,06,000, then multiply by 2, you will get 12,12,000. So this is how we calculate the purchase of super profit method. This is how we calculate the goodwill under this purchase of super profit method. The second one, annuity method. Goodwill in this case is a discounted value of the total amount calculated as per the purchase method. The idea behind super profits method is that the amount paid for goodwill will be recouped during the coming few years. But in this case, there is a heavy loss of interest. It happens to be heavy loss of interest. Hence, properly speaking, what should be paid now is only the present value of super profit paid annually at the proper rate of interest. The table shows, the balance sheet shows that the present value 18% of P1 received annually for 2 years is 1.566. That means 1 rupee 57 paise. So this is the annuity table source. In the above example of the given sum, the value of goodwill under this method will be 1.3, that is 1.3 multiplied with 6,06,000. So it comes around 9,49,000. So I'm giving you a single balance sheet and details and making you to apply all the methods in different situations. The next is capitalization of super profit method, when this method can be applicable. This method tries to find out the amount of capital needed for earning the super profit. So what we used to do, we used to use the normal equation like super profit divided by normal rate of return. So in the given example, the goodwill will be super profit is 6,06,000 divided by 18%. So in that case, the goodwill would be 33,67,000. Then what to do? So goodwill is huge because of the capitalization. So if the problem gives you 3 details or any one of these 3 details, information of old firms, assets and liabilities, as I have given in the screen now, and information regarding past or past profit, adjustments, valuation of goodwill. All of these 3 already is given in this screen, in the same illustration. Now we are required to prepare the valuation of goodwill by different methods. So now let me explain what are the steps to value the goodwill for the same sum under different methods. Method 1, goodwill by purchase of average profit method. So in this we need to follow 3 steps. One is find out average trading profit. Second step, find out the number of years of purchase. Mostly it always given in the problem itself. Then goodwill is equal to number of years of purchase with the average trading profit. So the average profit means just take few years profit and divide by number of years. So by this way you can calculate the goodwill. The second method, a goodwill by purchase of future maintainable profit method. So here we need to follow 3 steps again. First, find out the future maintainable profit. And then step 2, take the number of years of purchase which is given in the problem, and then calculate the value of goodwill by multiplying the number of years of purchase with the future maintainable profit. The third method is goodwill by capitalization of future maintainable profit. So we have learned when to apply this. Now we are learning how to apply this. Step 1, find out the future maintainable profit. And second, find out the capitalized value of future maintainable profit. So which means future maintainable profit divided by normal rate of return. And then calculate capital employed at the net realizable value of reserves, or we can simply call this as capital employed. The fourth step, we can calculate the goodwill. The goodwill is the differences between the capitalized value of future maintainable profit, which we calculated by the normal rate of return, minus the capital employed. The extra amount is called as goodwill. Then the fourth method is goodwill by purchase of future profit. So what we call this as super profit. So now for this we have 8 steps. Step 1, please students, please learners, take a note of it. It helps a lot for you to attend the multiple choice questions. So every week's time will post that, no? So it helps you. Step 1, find out average trading profit. Step 2, find out the future maintainable profit. Step 3, find out the capital employed. So if you have these 3, then you can proceed. Then step 4, take the normal rate of return. It used to be given in the problem in percentage. And take the number of years of purchase, fifth step, which is given in the problem itself. Then find out the normal profit in the 6th step. Here normal profit in the sense capital employed multiplying with the normal rate of return, which you have calculated capital employed in the 3rd step. Take that and multiply with the 4th step, the normal rate of return, which is given in the problem. Then find out the super profit. Super profit means future maintainable profit minus normal profit. Then at the last 8th step we can find out the value of goodwill by multiplying the number of years of purchase with the super profit. So we have seen till now 4 methods. The 5th method, goodwill by capitalization of super profit method. Goodwill by capitalization of super profit method. So what it is? Simple, only 2 steps. Calculate super profit as we discussed in the previous methods, and then goodwill is equal to super profit divided by normal rate of return. Then the 6th method, goodwill by present value of super profit method. So calculate super profit as discussed above, and then take goodwill is equal to annuity rate, which is expected and given in the question, and multiply with the super profit. So it always covers the interest part. So with this illustration we learned how to apply the different methods in different situations. So it helps a lot for identifying the question and match the method when it has to be applied. Let me give you the next example sum which I will be applying any one of this method based on the question. Now let us go through the next illustration where they are requested us to calculate the goodwill in a particular method. So from this previous lecture you must have understood the steps as well as the method to calculate the goodwill. So let me brief the question now. X agreed to purchase a business of Mr. Y on 30th June of a particular year. Profits earned by Y for the 3 preceding years were listed below. Year 1, Year 2, Year 3. Year 1, 82,000. Year 2, 80,000. Year 3, 84,000. The profits for the year 2014, it includes, that is year 2, it includes an abnormal income of rupees 3,000. Abnormal income, which is not going to be regular phenomenon. The profit for the year 3 is arrived after writing off a loss due to theft. So what happens? The theft never going to be regular mode. It happened only in a year. So this has been written off, which is subtracted, but it is not going to be a regular mode. At present, the assets of the business are not insured, but Mr. X, who is going to buy the business from Y, wants to take a comprehensive policy and has ascertained that annual premium of rupees 400 would have to be paid. So this is going to be a regular expenses in future. So the insurance premium amount is about to be paid every year for insuring the entire assets. So X is taking comprehensive policy. He is expected to pay. He is expected to have an extra expenses in the upcoming year regularly. So it's going to be recurring mode. So we need to subtract that from the calculated profit. Mr. X would like to manage the business full time, and this would involve giving up the present job in which he is drawing rupees 2,000 per month as an honorarium. So now this is going to be, he is going to lose that. So that have to be subtracted because this is also a regular expenditure, recurring nature. If Mr. X manages the business, the employment of the manager who is looking after the business for a salary of rupees 1,500 per month can be terminated. So what happens? This 1,500 per month is going to be nullified in the future. So it's not going to recur in future because the X itself, X himself is going to manage. It's a full time. So 1,500 is not going to be the expenses in future, so it can be added. And Mr. X will draw a salary of rupees 2,000 per month from the business. And now calculate the goodwill. If both the parties have agreed to value it at 2 years purchase of an average profit. I hope you understand the question well. So what are the items to be subtracted? What are the items to be added? So as we have seen in the previous illustration, I explained what are the steps to be carried out to adjust the profit. So now, as I explained, you must have taken a note in your notebook with proper steps. So now I request you to value the goodwill, to calculate the goodwill. So I will orally I will tell you before releasing the answer to you what are the things to be done, and I request you to follow my lecture and please make a note in your notebook, at least in a working way, like a working note. At last let us calculate the goodwill, and then I will reveal the answer in my screen. I hope you understand better, so that instead of releasing the answer in a single screen, this bit this will make you to jump the video. I don't want that. So you need to pay attention. I used to say why it is added or why it is subtracted, why it has to be multiplied, what order it has to be go. So if you listen that, if you pay attention towards that, you will come to know why, the reason behind that addition and subtraction. This makes you to attend your multiple choice question, which used to be posted every week in the SWAM platform or NPTEL platform, wherever you attend this YouTube lecture. You can click the answer so predominantly, so perfectly. Okay? So now let us take the average profit. For taking the average profit, we need to take the profit for year 1, year 2 and year 3. And in between, if there is any adjustments that have to be taken into account. So now profit for the year 1, rupees 82,000, it is given, and there is no any other additional information. So we can take as it is that particular profit 82,000. So we can write that in the final column, the outer column. Then profit for the year 2, rupees 80,000. Please make a note, this has some adjustments. We have few additional information with respect to year 2. So write that 80,000 in the inner column. And now go through the adjustments with respect to year 2. We have an abnormal income, so which is not going to be regular, but it has been added and uplifted your profit to 80,000. So now we have to subtract that. So 3,000 if we subtract, we will get 77,000. From 80,000 if we subtract 3,000, 77,000 is the result. Is there any other adjustments to be done for 2014? That is year 2? No. Particularly 2014 or year 2 do not have any other adjustments other than this abnormal income. Yes, we have the salary to be paid for the manager, the salary expenses to be paid to the Mr. X in the future. So that is because that is common for all the 3 years. That is not particularly for 2013 alone or year 1 alone, or not particularly for 2015 or year 3 alone. It is common for all the 3, so let us take that into consideration in later part. So now I am adjusting the either adding or subtracting of that particular year additional information. Now year 3, we have a profit of rupees 84,000, which is given in the question. I hope you, that's why I kept this screen so that I can watch that question and write. So profit for the year 3, rupees 84,000. So what are the adjustments we have with respect to this year 3? Yes, we have the loss due to the theft, which is an abnormal, which is not going to be continued. So that loss have to be added back. Already our loss have been subtracted. That 84,000 have arrived after subtracting the loss due to the theft. But in future it is not going to be. So you need to add that loss back to the profit so that you can get the actual profit before the loss. So only we are adding that. So 88,000. So now what is the total profit? Total actual profit is 82,000, 77,000 and 88,000. So the total actual profit is 2,47,000. Now take the average profit. Take the average profit. So 2,47,000 divided by 3 years we have, so 3. So we will get around 82,333. Now, what is the common adjustments to be done for all the 3 years? So one is expenses to be paid for the future insurance premium, because Mr. X would like to insure all the assets under a comprehensive insurance policy, and we are expected to pay a premium of rupees 400 per annum. So that expenses need to be subtracted because it's going to be a recurring expenses in future in all the years. So 400 premium need to be subtracted. Any other adjustments? Yes, Mr. X is expected to get a salary of rupees 2000 because he is going to employ himself full time into this business. So 2000 salary and multiplied by 12, you will get 24,000. You will get 24,000. So total subtracting item, because these two are recurring expenses in the future. So the total subtracting items is 24,400. So from 82,000 to 3, if you subtract 24,400, you will get around 57,933. Then we also have the manager's salary, which Mr. Y have paid every year, 1,500 rupees. That month he has paid every year. So it is a common expenses which he has made, but now Mr. X, when taking over the business, he is going to stop the manager's salary. He is not going to pay. Manager will be eliminated. So that expenses is not going to be in future, but it has already been subtracted in all the 3 years. So now what we need to do? We need to add, since it was already subtracted, we need to add those manager's salary. 1,500 every month he has paid, so 12 months it becomes 18,000. So now expected average annual profits becomes 75,933. This is the average annual profit, not the goodwill. Some students used to do this mistake. They will take this as a goodwill and proceed. Right? They will write this answer in the exam and they will stop. So main answer they used to miss. So this is only the average annual profit. Using this, we need to calculate the goodwill. We need to value the goodwill. So expected average annual profit is 75,933 and multiply by the number of years of purchase, which is given in this question for 2 years. So multiply that 75,933 and multiply that with 2 years. So total value of goodwill is going to be rupees. I'm not going to say, you must have calculated. Post that in the comment. So I will watch how many minutes you have watched and in which time you are posting your comment, so that I can ensure that you are traveling along with me. Yes. This plan has this advantage to monitor your listening capacity in this lecture. So calculate the value of goodwill and then proceed. So here I said why we need to add some adjustments, why we need to subtract that adjustment. That's needed. The reason behind that addition and subtraction is most important. That only makes you to understand the concept. Otherwise, blunderly adding or subtracting will not help you into the future. Will not help you in the future to calculate similar sums. If the similar sum is given with small alteration in the question, you will fail to answer the same question in the similar method, because without learning the reason behind for addition and subtraction will make you to solve the question in a wrong way. That's why I explain in detail by keeping this question in front of you. So with this, let me stop and proceed to show you the answer key. I will show you the solution now. So now you can verify your answer one by one, right? Whichever you have written in the notebook, you can verify one by one. All the multiple choices questions, even in the professional exam, they would like to test your concept understanding. They would like to test your conceptual understanding. That's why I gave a proper explanation for all the adjustments. Now let me reveal the answer key, the solution part. Yes, I hope you are able to see the solution part now. So have three columns, particulars, rupees and rupees. Then start with the profit for the year 1, year 2 and year 3. Wherever the adjustment is there, write up in the inner column. If there is no adjustments, put up in the outer column. So year 3, year 1 profit is 82,000 since there is no adjustments, post in the outer column. Year 2 profit 80,000. It has an adjustments with respect to this particular year alone. So put up that in the inner column. The profit for the year 3, rupees 84,000. This also has an adjustment for this particular year alone. So let us write that in the inner column. So that's why it has been posted in the inner column. So all are the adjustments to this particular year are not common to all the year. Right. So some adjustments which is common to all the year, which can be adjusted in the later part. But some adjustments which is only for that particular year can be adjusted towards that year. That's why we have written in the inner column. So first adjustment was that abnormal income for the year 2, 2014. So that's not going to be a regular mode in the future. So that was already added in the existing profit. That's how the 80,000 has been arised. So now we need to subtract the 3,000 because it has already added. Now we need to bring down the profit. We need to we need to calculate the actual profit without having that abnormal income. So in that case, we will get the profit for year 2 is rupees 77,000. Then loss due to the theft, which happened in the year 3. So it was already subtracted, so they arrived 84,000. But it was not supposed to be subtracted because it's not going to be regular in future. So we need to add that again to bring the actual profit. So 84,000 arrived in the year 3 after subtracting the loss due to the theft. So now we need to add that into the actual phenomenon to get the actual profit, that is 88,000. So now we get the total profit 2,47,000 as I was explaining in the course along with the question. 2,47,000. Now take that 2,47,000, convert that into an average profit for 3 years. So since it is for 3 years, divide by 3. Divide by 3. So you will get 82,333. Then subtract the expenses to be paid for future insurance premium. As I was explaining, this is going to be in future, but it was not in the earlier years. But however, this is a recurring expenses, so need to be subtracted. This is going to be in future. This was not happened in the earlier years. So subtract that 400 rupees. And Mr. X would like to be a full-time employee and leave his existing employment and would like to employ himself as a new employee and take the same salary which he was earning in the outside business. So take 2,000. So for 12 years, for 12 months, so it comes 24,000. So total 2 expenses is going to be new expenses into the future. So this have to be subtracted 24,400. If you subtract this, you will get 57,933. Then Mr. Y, we are paying the salary to the manager every month for the last 3 years, 1,500 rupees. So for 3 years he has paid. Since we have taken an average, now we can take it for only 1 year. So already it was subtracted, but now since it was subtracted, now we need to add because it's not going to be regular in future. So add that manager's salary, 1,500 rupees per month. So multiply by 12. Actually we have to multiply by 3 because 3 years, but since we have taken average, we now need to multiply by 3 years. Right? Because multiplying by 3 then dividing by 3 will give you a net result. Net effect is going to be same. So multiply only by number of months, 12 months. So it comes around rupees 18,000. So now add that, by adding that with 57,933, we will get rupees 75,933. Now this is the expected average annual profit. And now the goodwill can be calculated by multiplying the expected average annual profit which we have arrived now with the number of years of purchase. So if you multiply that, I will get the actual value of goodwill, that is going to be rupees 1,51,877. I hope you must have get this answer in your working note, which when I was delivering the lecture. In the 35th minute, you must have get this answer. In the 50th minute, you must have get this answer. And I hope you have posted this answer in the comment and for reviewing your performance to calculate the internal arc. So let us go through the next illustration. In other method, from the following information given by Tata Telecom, calculate the value of goodwill. So they have given three information. One is the average capital employed, rupees 12 lakhs. Next, the company declares 15% dividend on the shares of rupees 20 each, which are fully paid, which is quoted in the market at rupees 25. Net trading profit of the firm after calculating the tax for the past 3 years is given 2,15,200, 1,81,400 and 2,25,000. Now we are required to compute the value of goodwill on the basis of 5 years purchase. Please make an underline, 5 years purchase of super profit. Please again make an underline. So 5 years purchase of super profit of the business calculated on the average profit of the last 3 years. So in this question, let me request you to solve and apply this. So simple, we will follow the methods which I explained in 35 minutes to 15 minutes. We will solving the sum. So please go through that, and now I will give you the solution on the screen, and I will simultaneously may copy this and explain. So calculate average profit. So total profit and then divide by number of years, so average profit. Now calculate the super profit. Average trading profit, what we have calculated, 2,07,200 minus the normal profit at 12% on rupees 12 lakhs, which is given in the question itself. So 1,44,000. So by this we can get super profit rupees 63,200. Now value the goodwill. Goodwill means 5 years purchase of super profit. So how it happens? 5 year multiplied with 63,200. So if you multiply this, you will get 3,16,000. That is the value of goodwill. Now you will wonder how this 12% has come in the valuation of normal profit, because they have given dividend per share is 15% of rupees 20, it comes rupees 3. Whereas the rate of return on capital, which means normal rate of return, is dividend paid divided by market price of the share, which is given in the question. 3,525 multiplied by 100, you will get 12%. 12%. So dividend per share divided by multiply divided by market price per share into 100, you will get 3,525 into 100, you will get 12%. That 12% you need to use as a normal rate of return and multiply with the capital employed to get the normal profit. So the excess of normal profit, excess of average trading profit over and above to the normal profit, we call this as super profit. and then use that super profit, multiply with the number of years of purchase, we would get exactly the value of goodwill. That is rupees 3,16,000, what I have shown you now. So please copy this in your notebook and understand the reason behind the valuation, adding, subtraction, applying the methods. So which I explained between the 10th minute to 35 minutes. I explained the methods along with the reason which we need to apply by showing you an illustration. So I use that. Have a good day. Have a wonderful weekend, and get ready for the MCQ multiple choice question, which is going to be released in the upcoming next week Monday through the Swine platform, and you are expected to answer on time. Thank you. Have a good and wonderful day.